Hey guys, Tim Kutch. There are two kinds of annuities. There are growth annuities and there are income annuities. And there's a whole myriad of hybrids and different products and writers, increasing income options, death benefit, ratchet up possibilities. There's a whole bunch of stuff out there. I just want to do kind of a 101 training on how I go about creating the strategy in my client's mind for setting up myself the opportunity to do a growth annuity in addition to AUM. So you have to have a securities license to do assets under management. To preface this video, if you haven't watched the Fact Finder, definitely 100% absolutely stop. Watch that video first, then come right back here. That and the risk tolerance questionnaire have to be done before you can hop into this part of the presentation or client meeting when you're getting together with them. So after I filled out the fact finder, after I filled out the risk tolerance questionnaire, let's say that they're conservative moderates or maybe moderates. As far as the risk tolerance, maybe they have $1 million. They're going to get Social Security, but their expenses are just a little bit more than what is going to be coming in for Social Security and that sort of stuff. So they got $1 million saved between IRAs and 401ks and that sort of stuff. We'll call it qualified money, although this strategy is going to work the same way for non-qualified money. We're just going to be able to manipulate the tax wrapper and their taxes for this year and future years income a little bit better if they have non-qualified money or Roth type of investments. So I'll go into all that stuff in a different video if you guys don't understand the differences on that. But let's just, for today's simple purposes on learning the growth annuity strategy, go over just a traditional IRA or a 401k. So pre-tax money went in. When they take money out of it, they're going to have to pay taxes on it. Okay, so and it's grown tax deferred that whole time. So that's for today's purposes. How I set this up in my client's mind is twofold. One, I want to gauge their level of financial acuity by giving them the simple, it's kind of a one question IQ test. If you put $100 in the stock market and it goes up 10% and down 10%, how much money do you have? A lot of people, even insurance agents and investment professionals, all the same, think you break even. And we wish that were true, but we know volatility actually hurts people. So as an example, you can do this on the 10% or down 10%, but I like to give the example when I'm there, right there in front of my clients is, 2008, 2009, it had that 35% crash and then subsequent recovery. So let's just do it on that 30% kind of basis so we can use some round numbers here. And let's look at, if the market goes down, then comes back up, what you're actually at. And so that volatility is not necessarily a good thing. So I'm going to go ahead and share with you my calculator. And you can do this on a calculator or a computer or however you want to do it. It's just the most simple formula ever. We'll take $100 as an example. We'll times that, and you can do this either way. The math comes out all the same. We do up 30%, so times 1.3, and they're going to have $130. Okay, that's simple. Now let's say if the market goes down 30%, so times 0.7, because we're taking 30% out, and they're left with 91. Now, how did that happen? Well, we were taking 70% of 130 instead of 100, and so the math isn't the exact same. So volatility, when the market goes up and down, you actually lose. It's not as good, and it's more significant on a more significant basis. So, if the market is up and down 50%, it's going to be that much more applicable. So I'm going to show you the next thing, which I don't have pulled up here. So we're just going to, let me pull that up. Probably should have had that pulled up. Here it is. I'm going to share with you the sequence of returns. There it is. Okay, so now you can see this. This first page is just showing about the probability of different success rates over a 25-year period of time. I don't go too much into this page because I kind of do this on my own. I've built some software that plans this out even to a bigger degree than just these random chart percentages based on, if you withdraw 4%, you're more likely to succeed rather than if you draw 8% of your portfolio. And if your portfolio is in 100% bonds all the way through a mix of 100% stocks, you can see, the higher percentages, you're actually going to have some stocks, some bonds, and you're going to take out 4% instead of 8%. So common sense, and 3% is even better. Depending on these clients' money, we're going to be able to do a number of different things. Here's where I really illustrate, though, is the next 2 pages. So we've got Mr. Green, Mr. Blue, and Ms. Brown. In an up market, a down market, and an average market. You can see if we take $1 million, age 65, because this used to be the common retirement age. I know FRA is now, full retirement age is now 67. That's not going to have a huge impact on anything that we're talking about, because we're just talking about strategy right now and getting these clients to understand why we're going to do what we're going to do here in a minute for their strategy. And after we've got the strategy and after we've got their okay on the strategy, then we backfill with product and company and case design of that annuity and AUM. So just real quickly, in an up market, we're saying up 5%, up 28%, up 22%. That's really good in an up market. In a down market, we're down 25, down 14, down 10. Now you can see if we scroll down, these numbers are just flipped. We've got 25, 14, 10. We've got 25, 14, 10. All these numbers are literally just flipped, but we don't know what's going to happen. So it could be an up market, it could be a down market. It's not going to be 6% every year forever, but that's just showing you that all of these on an average get 6% rate of return. And you can see on this page during accumulation mode, Mr. and Mrs. Client, it really didn't matter, how the market was doing in any particular year. As long as you were doing what you were doing and you invested that $1 million, it's the same. So not true necessarily with dollar cost averaging and when you're doing contributions and all that stuff, but this is how most people think about investments. They put money in and then it grows and then they get their 4.2 million at the end of the deal. Cool. Okay. Most people understand that. The reason I'm showing this is to put in their mind, they need a distribution strategy. And the reason for that is when you add distributions into the mix of things, when you add withdrawals, this whole thing can blow up a portfolio. And what I mean by that is clients can actually outlive their money if they're doing this incorrectly. So in an up market, we're up 5, up 28, up 22, while taking 50,000 or 5% of this $1 million portfolio a year. You can see in an up market, we're okay. We've grown that 1 million to 2.5 million. We've taken out our 5%. Our success chance is pretty darn high in an up market. But in a down market where we start off down 25, down 14, down 10, this thing gets to it's under $500,000, and it never has the ability to recover even with huge like 16 and 21% gains after that. And taking out $50,000 or 5% withdrawals in a down market is really, really bad. It blows up the portfolio. The portfolio can never recover, and that's because we're simply taking out too much on bad years. 50,000 of 552,000 on this second and third year here. That's 10% of the portfolio, even though we started with 5%. That percentage changed based on the balance that we had actually in there. So the whole thing is just to say what we want to do is reduce the ability to have that volatility in our portfolio. So we can do that 2 ways, Mr. and Mrs. Client, and we're actually going to recommend very likely both ways. So I'm going to show you what those both ways look like for you. And now I need to share with you guys a whiteboard, and then I've never used a whiteboard before in a video, so we are going to just kind of figure it out together, so bear with me. I'm going to show you a couple of different things. Okay, so option 1, and this is what I call the short-term bucket. You can have 2 short-term buckets or more if you want. You can break this up into a number of different ways. I'm just going to show you kind of the 3-bucket approach. And I'm really hoping you guys can see this whiteboard here. Not the physical one behind me, but the one I'm sharing on my screen. Okay, so I'm going to show you the 3 buckets. We'll do bucket 1 and bucket 2, and bucket 3 over here. Okay, so say we've got $1 million, and we know we don't want all of that huge volatility. Okay, so I'm going to show them two graphs. I'm trying really hard to figure out this whiteboard. All right, pretend that's a straight line. And what we're going to do, is there an eraser? Yep. Oh, wow, erase that whole thing. That wasn't cool. Let's try that again. Okay, just pretend I'm a really good artist for 5 seconds. Okay, so this is a graph, and this is kind of what the stock market does. It goes up, and then it goes down, and then it goes up, and then it goes down, and it keeps on doing that on kind of a continuing basis, okay? So over a long period of time, the high highs are going to be up and the low lows are going to be up, even though we come crashing down in different parts of this whole thing. So what I want to show you, Mr. and Mrs. Client, is that we can take, see if I can change my color here. Yeah, sure, we'll do red. We can do something very similar to what your 401k and IRA did, which is take these high highs and low lows just kind of on a disproportionate basis. So you're not going to get the high highs, but you're not going to get the low lows. And it's going to kind of mitigate, you know, and go through this whole thing just kind of on a more average basis. The reason being is we want to be that Ms. Brown, that 6%. Now, it's not going to do exactly that, because when the market goes up, this is still going to go up just on a limited fraction. And when the market goes down, this is going to go down, but just on a limited fraction. And that fraction is going to be based on their risk tolerance questionnaire, how much risk they're willing to take, and we're going to blend that in their overall portfolio, okay? So this is a piece of their strategy. I call it their short-term bucket. It's going to be in typically a traditional IRA if they've had a 401k, and I'm going to put the tax wrapper of traditional IRA on it. The internal investment is probably going to be some type of security. So I'm securities license 66365. Don't worry about that for the moment. The whole point of this is really to sell the growth annuity, which any insurance advisor that's taken their NEIC suitability and the product training for the carrier and has an insurance license for life and annuities can sell. So I just want to show you that this is going to be their short-term bucket. So say they want, $50,000 a year, kind of as in the last example, but how I'm going to position this for them is going to be a little bit different. So I'm going to call this their 1, 2, I'm sure there's a text, but I'm just going to draw it, 5-year bucket. We're going to really highlight kind of in this 2 to 4%. And this is going to be kind of their conservative bucket, okay? And based on their risk tolerance, you can dial this in a little bit more. We can backfill with products like BlackRock, Morningstar. There's a number of good securities carriers, and those are going to be the same for bucket 1 and bucket 2. So if they want $50,000 a year, I need this to last them maybe 5 years. I'm going to put of their $1 million, maybe $250,000 in bucket number 1. Okay. So in bucket number 2, it's going to be very similar. So I'm going to put 250. Sorry, I'm drawing all this. I'm not sure how to use the text. Oh, there's the text. I see it. But I have to create a box and whatever. Okay. But I'm going to call this the 5 to 10. And what I'm doing with the 5 to 10 year is I'm being a little bit more risky. So maybe I'm doing some type of moderate portfolio, again, depending on the client's risk tolerance. And here we are targeting kind of the, I'd say 4 to 6% rates of return on this type of security. So we can, because we're willing to take a little bit more risk, and again, this is not in any one given year, this is over a long period of time, kind of what the averages are going to show for them. But the reason we're doing this one conservatively is because we want this to not hardly dip at all. It's going to be almost a straight line of growth up here. And so when we're taking money out of the portfolio, we're putting it into their checking account, and they're spending it on life necessities, etc. We're never taking money out on a down year, so we can never be that, down market in the last example that I showed you based on the sequence of returns. And if you need any of this marketing material, just reach out. Again, I give all of my material and content and education away for free. Whole goal is helping people. And so when I maximize my calendar and I see 30 or 40 people, I know the only way I can help more is if I teach agents all of these principles so that you guys can help people in your local community. So we're going to put that second bucket over here. And now I'm going to show you guys really the second concept to this whole deal. And this third bucket, what I'd like to do, Mr. and Mrs. Client, is put the money that we don't need for the next 10 years. So I'm doing that because, and you can figure out these numbers a little bit differently depending on the surrender period of the annuity that you're attempting to sell. So 1 to 6, 6 to 12, and then that'll give you a 12-year annuity. There's some nuances if you're willing to be a little bit flexible with free withdrawal and get that 10% after year 2, etc. on your annuities. You can do in this sort of deal. But here we're doing 10 plus years, okay? And so now I'm okay on a surrender period because I have a bucket of money, a large one, $500,000, and this is how I sell $500,000 annuities, is creating a bucket of money that we know we're not going to need for at least 10 years. And with this, the risk tolerance is kind of different because it's a different line than both of these lines. So far, all you've really been accustomed to, Mr. and Mrs. Client, is, you put money in, the market goes up, you get, your account goes up. And it may do that to a limited degree, depending on your blend of equities and, stocks versus your cash and cash equivalents, bonds, treasuries and the short-term, long-term yield stuff. But irregardless of all of that, it was basically just a limited basis. So it was basically some sort of version of this red line, all the way to a maximum of this gray line if you're super duper aggressive, okay? I'm going to show you guys a different line here, though, and why this is really cool is because you guys probably haven't experienced anything like this before. So what happens on this line is we do some type of annuity, and what happens is we can capture a large majority of whatever index we decide, and when the market starts to go down, we don't lose a single dollar, and we've locked in that high point. And when the market starts going back up again, we get that same growth, so the really high stuff. And then when the market crashes, we don't lose a single dollar on this deal. And then when the market goes back up, it keeps going. So you guys can kind of see how this blue line beats the red line and is better than the gray line at basically all points. Now, we'll have to backfill and product fill with the carrier for the annuity, but also the index that they're willing to be in. And then they're either going to have some sort of participation rate, meaning if that index goes up 10% and they're at 140%, their account would go up 14%, or some sort of cap. So if the market goes up 10% and their cap is 7%, it's only going to go up 7, but also on the downside basis, it's not going to go down at all. So that can be on a year-to-year, point-to-point. It could be on a 2-year point-to-point. Sometimes you get higher participation and higher caps if you go a longer period of time. But you can do any number of things in an annuity. But just as a simple basis, most people understand, hey, this blue line is really cool. Why wouldn't we throw all of our money in it? Here's why. You can't, because what we need to do is once we've spent bucket 1 in those 5, and maybe you don't need all of it and it's totally flexible. If you want 50,000 January 1, cool. If you want that broken up into 4,000 and a couple $100 on a monthly basis every month for those first 5 years, you can do that. We have total freedom and flexibility. But when we take money out, because all of this was assuming to be in a 401k or an IRA, you're going to pay taxes on it. So this 50,000 in retirement plus Social Security, which might be 2,000 or 3,000, depending on your guys's last, your highest 35 earning years, taken out, weighted over time, etc. So we've got Social Security plus this income coming in, plus any pensions that we might have. And again, that's why the fact finder is so important, is because you can help them determine bucket one. And then you're basically doing everything else in bucket two to refill bucket one. And then bucket three is going to be your big annuity. So that's kind of the goal of all this. Once you've done a fact finder, you know what they're going to want in these buckets. And when you break down a comprehensive plan like this, it just looks so simple. So now they've committed, and as long as they commit to the red line, the blue line, all you're doing on the next meeting is giving them the annuity and the securities that you'd like to fill the blue line and the red line with, and then having them sign the paperwork, and then calling the contra firm and asking them if they have a move money form or a transfer form, or if they'll accept contra paperwork from the new investment company. So really easy, rolling money. If you haven't done it a million times, it takes 30 to 60 days. Some places are, here's our money. All we need is, the contra firm's paperwork. Some of them are, we require our own paperwork, and we require a medallion signature guarantee, which is like a level higher than a notary. If you haven't experienced that, usually only applies to accounts that are $250,000 or more. So not your typical 30 or 50 or 100,000 here or there, but the bigger stuff. And then some of them require phone, PIN, or voice activation before they'll get you to a representative, before they'll give you the transfer paperwork. So some of them can be a nightmare to work with, just depending on their 401k company or their IRA, if they've rolled this over previously. So that's kind of the general scope of things. In here, I'm targeting 6% plus as far as their rates of return. And then depending on the index and how I want to go over it, it'll fall into, anywhere from conservative to more moderate risk tolerance when you're doing the annuity. Nothing super duper aggressive. You're never going to get 1,000,000%, but that's what we're targeting, is higher than 6%. The reason we do these three different buckets, like I was saying a minute ago, we've spent the $250,000. Okay, but I've grown this at 4 to 6% over, between 5 and 10 years. I've done pretty well to replace bucket one, which is now depleted after 5 years. So this might have grown to maybe 400,000, and we're taking, 250,000 and moving it over here. And then over on a 10-year or longer basis, the goal on this whole deal is to double it or triple it, depending on how good the annuity is, how well the indexes do, and how well the market does overall, depending on those indexes over the next 10 plus years, and how many times you've, ratcheted in this lockup step. 1 year you're on a 2-year basis, or you can even do it more frequently than that, depending on the annuity. But this bucket is generally refilling bucket one and bucket two, because we've recreated $1 million here. And so we've made sure that their net worth, sorry, my drawing is terrible. We've made sure that their whole net worth over time is growing. And we've refilled all of the buckets so that they can continue to take out their $4,000 and a couple $100 on a monthly basis to equate to that $50,000 a year forever. And once we've designed this plan that, hey, your net worth is actually going to grow, because I'll put this at maybe a guesstimate of 1.2, 1.3 million over a 10-year period of time. I took $1 million, gave you your $50,000 every year forever. We've made sure that that doesn't hurt your portfolio by using this red line and kind of mitigating the risk based on that sequence of returns example I showed you. We're not going to ever take money out in a down market. The worst down market you could ever really experience on this conservative basis is maybe 3 or 4% down. So we're going to be okay taking money out of that forever. And as long as we have a strategy to refill these buckets, we're going to be okay taking, not necessarily more risk, because we have a guaranteed basis here that we're not going to lose money, but chasing after a little bit higher rates of return. So between those three buckets, and you can do 2 buckets, and you can do, 1 to 10 year and 10 year plus in 2 buckets, depending on the clients and their level of sophistication. When I do this in my local area, and I train other agents on how to do it. I'll vary my approach on all this and give you guys just what I gave them, kind of as a simple overview of, does that make sense? Can we go back and figure out what products are going to be best for the red line and blue line and put that together and come back and show you what that looks like? When I come back together and show them what that looks like, I'd say a lot of times they've already committed. They've already, started cashing out their old policies. They've got their old 401k statements ready to rock and roll to get the money to move. We can, on that initial appointment, if they've committed to the blue line and red line, we can call the carriers and ask them to, send us the forms for transfer. That way, when we get back together, all we got to fill out is the new firm's paperwork if they agree to the products that we're putting in there. And there's a number of good, securities stuff for bucket 1 and bucket 2, and a number of good annuity stuff for bucket 3. But this is how I go about selling those $500,000 annuities to the people that have that sort of stuff. In addition to this, I'm going to give you kind of my huge trick for big money. We've said that we can, in this client's example, we're going to, over a 10-year period of time, we're going to turn this into 1.2, 1.3 million. It'll refill those buckets on a continuing basis. But if we do this time and time again, we're now talking about in excess of wealth that they're not going to outlive. And we've done the fact finder and we've protected them with things like long-term care insurance, and they've got med sup, and basically anything that comes their way, they're going to feel comfortable with, because of the insurance protection that we put in place for them. Now we can have the conversation of, hey, you've got this money, it's still growing for you. You may even, at some point here, we'll have your house paid off and you won't have that mortgage bill. You may even need less than the 50,000, and I'm growing your net worth for you. And that's all great and dandy, but rather than just grow it and then just pass away and just leave that money in taxable accounts, I can show you a strategy where we start taking that money out now based on your lower income because you're now not working, and give that to your kids so that when they get this money, it's on an exaggerated basis. It's accelerated because of life insurance, and the death benefit is thereby going to be tax-free. So maybe we take 100,000 of this portfolio I know I'm going to grow for you, and we'll put 100,000 and we'll put that in life insurance, and that turns into maybe $250,000 based on your age and health. And maybe if we're doing a survivorship plan, insuring both people, we can get a little bit better. If you haven't heard of SGULs, Survivorship Guaranteed Universal Life, they're my favorite for wealth transfer. They really are. And I'll go through kind of my whole life insurance and product pitch another time for you. But know that SGULs and single premium SGULs are just, you make a ton of money, you really truly help the clients better position their wealth, and we can start carving off, maybe 20,000 of this each year, so they don't get a big, huge $100,000 tax hit, but we're putting it on the parents' taxes. And if the kids are making 100 or 150,000, we don't want to increase their taxes, which they'll be forced to, by the way, if and when all of this money goes to them. If there's one kid and he's making 150,000 and we leave him a $1.3 million portfolio and he's only got 5 years to take it out and he's taking out $250,000 a year, his taxes are going to be insane. They're going to be a nightmare. So if we can better position this for wealth transfer and say, okay, well, the parents, based on Social Security and this 401k, are only making 70,000, we can portion off 20,000 here and there, and we're going to pay lower taxes. And for the parents, we're going to pay lower taxes than potentially the kid. And we're moving this money from, a taxable account that the kids will pay to a tax-free life insurance death benefit that they're going to get. And we're turning this 100,000 into 250,000. So an amazing, amazing deal and concept. Commissions on this type of stuff might be as high as, depending on your upline and blah, 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 and a million factors, but maybe 13%. So if you move 100,000, you're getting 13,000 real quick. It's kind of a nice commission. In addition to like $500,000 in an annuity, that's a great commission as well. So there's all kinds of fun extra stuff once they've agreed to this plan, and you get the plan rocking and rolling and it's doing everything that you guys need. Also, if you guys aren't securities licensed, you can partner with me and I can do that bucket for you. Or if you love another professional in your local area, that's great, partner with them. Depending on case size, I'll definitely fly out and help you, one, present all of this stuff in person, backfill the product, and then give you the high recommendation on the annuity that you're going for, to help you get this policy sold and this plan design implemented for the clients. Again, I feel like not enough insurance and investment professionals know all of this, and this is only one piece. So there's really, this is the growth annuity that we've been talking about. We're going to grow it and it's not going to go down, etc. I'll do another video on income annuities, and I don't always show the sequence of return and some of that other stuff, but when I know I'd like to pitch a growth annuity, this is how I do it, and this is the strategy behind it. So again, there's some more level of depth that if you work with me and you're in my hierarchy and all of that stuff, I'll go and help you figure out the best annuity, the best product, and then obviously, you know, the things that are important to you is it's got to work well for the client, easy and flexible, it's got to pay good commission, and they got to have awesome products. So I know all those things, and that's what I help advisors do, is figure out the best thing for their clients first, and then them second, and then the insurance company that backs everything up third. So thanks for watching this video. I hope you learned something. Again, I'll do a lot more of these videos over time. I just wanted to get a few of these out there so that you understand there's a lot of stuff to learn, and there's a lot of good people willing to give you free advice because we want to help you and we want to help other people. So thanks so much. Take care, and we'll see you soon.